Stock market overview. The stock market is a dynamic financial marketplace where individuals and institutions trade ownership shares in publicly listed companies. These shares, known as stocks or equities, represent partial ownership of a company. When you purchase a stock, you acquire a small stake in that business, entitling you to a portion of its profits, typically through dividends, as well as the potential for gains through the appreciation of the stock's value over time. How the stock market works. The stock market is a dynamic and essential component of the global economy, providing a platform for individuals, institutions, and governments to buy and sell ownership in companies. While the concept of the stock market may seem complex, it operates on straightforward principles that are deeply connected to supply and demand, investment strategies, and economic growth. In this article, we'll break down the basics of how the stock market works, from the issuance of stocks to how prices are determined. What is the stock market? At its core, the stock market is a collection of markets and exchanges where shares of publicly held companies are traded. These exchanges allow companies to raise capital by selling portions of ownership, called stocks or shares, to investors. In return, investors receive partial ownership of the company and the potential for future profits. Major stock exchanges, such as the New York Stock Exchange, NYSE, and the Nasdaq, are where most of the world's stock trading takes place. How stocks are created. Stocks are created by initial public offering, IPO. When a private company wants to go public and raise money, it can issue shares through an initial public offering, IPO. In an IPO, the company sells a portion of its ownership in the form of shares to institutional investors, such as banks or hedge funds, and to the general public. The money raised from the IPO can be used to expand the business, pay off debt, or invest in new projects. Once a company's shares are issued, they can be bought and sold on the stock market. The company's stock is then subject to the laws of supply and demand, which determines the stock's price. How stock prices are determined. The price of a stock on the market is primarily determined by supply and demand. If a large number of investors believe a company will perform well in the future, they are more likely to buy its stock, driving up the price. Conversely, if investors lose confidence in a company, they will sell its stock, leading to a decrease in price. Beyond supply and demand, stock prices are influenced by several other factors. Company performance. Profitable companies with steady growth typically see their stock prices rise. Economic indicators. Broader economic trends, such as interest rates, inflation, and unemployment, can impact stock prices. Market sentiment. Investor confidence and emotions often play a large role in market fluctuations, causing prices to rise or fall even without significant news from the company. Global events, political events, natural disasters, or shifts in trade policies can also affect stock prices. Stock exchanges and indices. Stocks are traded on stock exchanges, which are highly regulated marketplaces designed to facilitate the buying and selling of securities. The most well-known exchanges are the New York Stock Exchange, NYSE, and Nasdaq in the United States, but there are numerous other exchanges around the world, such as the London Stock Exchange, LSE, and the Tokyo Stock Exchange, TSE. Stock indices track the performance of a select group of stocks, offering investors a snapshot of how the market or a particular sector is performing. For example, the Dow Jones Industrial Average, DJIA, tracks 30 large-cap companies in the U.S., while the S&P 500 tracks 500 of the largest U.S. companies. Types of stock market participants. There are several key participants in the stock market, each playing a distinct role. Individual investors, everyday people who buy and sell stocks for personal gain, either for short-term profits or long-term wealth building. Institutional investors, large organizations, such as pension funds, mutual funds, and hedge funds, that invest substantial amounts of money in the stock market. Market makers, these are firms or individuals that provide liquidity to the market by being ready to buy and sell securities at any given time, helping to ensure smooth transactions. Regulators, government entities, such as the Securities and Exchange Commission, SEC in the U.S., oversee stock market activity to ensure fairness and transparency. Risks and rewards of stock market investing. Investing in the stock market can be highly rewarding, offering the potential for significant returns over time. However, it also comes with risks. The value of stocks can be volatile, and prices can fluctuate based on market conditions, economic trends, and company performance. Investors may lose part or all of their investment if a company underperforms or the market experiences a downturn. That said, the stock market has historically provided one of the highest returns compared to other investment vehicles, such as bonds or savings accounts, making it a popular choice for those looking to grow their wealth over time. Risk mitigation strategies. To reduce risk, many investors diversify their portfolios by investing in a wide range of stocks across different sectors or by using index funds, which spread investments across a broad array of companies. Additionally, investors often employ strategies such as dollar-cost averaging, investing a fixed amount of money at regular intervals, or holding stocks for the long term to mitigate the effects of short-term market volatility. Understanding market makers. Market makers are financial institutions or individual traders that actively quote both the buy, bid, and sell, ask, prices for a particular security or asset. By standing ready to buy or sell at publicly quoted prices, market makers provide liquidity to the market, ensuring that there are always participants willing to take the other side of a trade. Their primary purpose is to make markets more efficient by narrowing the spread between the bid and ask prices, which makes it easier for traders and investors to buy and sell without excessive price fluctuations. Market makers are typically large financial institutions like investment banks or specialized trading firms. However, in some markets, individual traders or smaller entities can also act as market makers. These participants are compensated for their service by earning the spread, the difference between the bid price and the ask price, on each transaction. How market makers operate and why they are essential. Market makers play a crucial role in financial markets by providing liquidity, which helps facilitate the smooth buying and selling of securities like stocks, options, and other financial instruments. They operate as intermediaries between buyers and sellers, ensuring that trades can occur without significant delays. Here's a closer look at how they function and why they are vital to the financial ecosystem. How market makers operate. Market makers are typically large financial institutions, brokerage firms, or specialized trading firms that continuously provide buy, bid, and sell, ask, quotes for specific securities. Their primary role is to ensure that there is always a buyer and a seller available in the market, thus maintaining market liquidity. Here's a simplified breakdown of their operations. Quoting prices. Market makers continuously quote both bid, buy, and ask, sell, prices for securities. For example, if a stock is trading at $50, a market maker might offer to buy it at $49.95, bid, and sell it at $50.05, ask. Earning the spread, the difference between the bid and ask prices is known as the spread, which is the market maker's primary profit source. This spread compensates them for the risk they take on by holding inventory of the security. Managing inventory, market makers maintain a balance between the number of securities they buy and sell to avoid excessive exposure to market risk. They use sophisticated algorithms to adjust their positions in response to market conditions and maintain a neutral portfolio. Providing liquidity, by being ready to buy or sell securities at any time, market makers provide liquidity, ensuring that trades can happen quickly and with minimal price fluctuation, even in high volatility periods. Stabilizing prices, market makers help prevent extreme price swings by stepping in to buy or sell securities when there are imbalances between supply and demand. This activity helps stabilize prices, making the market more predictable and less prone to sudden crashes or spikes. Why market makers are essential. Improving market efficiency, market makers ensure that securities are readily tradable, which helps keep markets efficient. This continuous availability of trading partners reduces transaction times and costs for investors. Reducing price volatility, by constantly buying and selling, market makers absorb shocks from sudden buy or sell orders that could otherwise cause significant price volatility. Their actions help maintain orderly market conditions. Facilitating price discovery, the bid and ask quotes provided by market makers help determine the fair market value of securities. This continuous price feedback is critical for investors making informed trading decisions. Supporting market access, without market makers, it would be difficult for investors, especially those trading in less liquid securities, to find counterparties for their trades. Market makers ensure that even less popular stocks have liquidity, allowing a broader range of assets to be traded. Enhancing investor confidence, the presence of market makers assures investors that they can buy or sell securities at any time, fostering confidence in the market. This trust is fundamental to attracting capital and sustaining market activity. 3. Liquidity risk. Although market makers provide liquidity, they also face liquidity risk themselves. This risk occurs when market makers cannot offload their positions quickly enough without significantly impacting the price, especially in times of market stress or low trading volumes. Example: during a market downturn, market makers might struggle to sell their inventory without pushing prices down further, amplifying their losses. 4. Volatility risk. High market volatility can pose a severe risk to market makers. Sudden price movements can lead to large, unexpected losses, especially when spreads widen or when market makers are unable to adjust their quotes quickly enough to reflect new market conditions. Example: in highly volatile markets, bid-ask spreads can widen rapidly, making it difficult for market makers to execute trades at profitable prices. 5. Counterparty risk. Market makers depend on other market participants to complete trades. Counterparty risk arises if the other party defaults or fails to deliver the security or payment, leading to potential financial loss. Example: if a market maker engages in a large transaction with a failing brokerage, they might not receive the expected payment or securities, leading to financial exposure. 6. Technology and operational risk. Market makers rely heavily on advanced technology, including algorithms and automated trading systems, to manage their operations. Technical glitches, system failures, or cyber attacks can disrupt their trading activities, leading to financial losses. Example: a malfunction in a market maker's trading algorithm could result in erroneous trades, potentially leading to substantial losses within seconds. 7. Regulatory and compliance risk. Market makers operate under strict regulatory frameworks designed to ensure market fairness and stability. Changes in regulations or failure to comply with existing rules can result in fines, restrictions, or the inability to operate. Example: regulatory changes that tighten capital requirements or impose new trading restrictions can affect a market maker's business model and profitability. 8. Competition risk. The competitive nature of market making means that firms must constantly innovate to maintain their edge. Increased competition can lead to narrower spreads, which reduces profitability. Additionally, new market entrants with superior technology can displace established market makers. Example: a market maker may find it hard to compete if other firms offer better pricing or faster trade execution, reducing their market share. 9. Interest rate and currency risk. Market makers dealing with interest rate-sensitive securities or operating in multiple currencies face the risk of adverse movements in interest rates or exchange rates, which can impact their positions and profitability. Market makers versus high-frequency trading, HFT. Market makers and high-frequency traders, HFTs, are both key players in modern financial markets, but they operate differently and serve distinct functions. Understanding their roles, strategies, and impacts on the market helps clarify how these entities contribute to market dynamics. 1. Definition and role. Market makers are entities, usually large banks, brokerage firms, or specialized trading firms, that provide liquidity by continuously quoting buy, bid, and sell, ask, prices for specific securities. Their primary role is to ensure that trades can occur seamlessly by always being available to buy or sell a security. This activity helps reduce price volatility and supports efficient market functioning. High-frequency trading, HFT. High-frequency trading refers to the use of sophisticated algorithms and powerful computers to execute a large number of orders at extremely high speeds, often in fractions of a second. HFT firms aim to capitalize on small price discrepancies in the market by executing trades rapidly across multiple exchanges. Their strategies often involve arbitrage, market making, and exploiting momentary imbalances in supply and demand. Key differences. Purpose and function. Market makers primarily aim to provide liquidity and facilitate trading. They profit from the bid-ask spread and are obligated to provide quotes consistently, even in volatile markets. HFT firms focus on exploiting market inefficiencies and making a large number of trades quickly to capture tiny profits from each transaction. They are not obligated to provide continuous quotes and can enter and exit markets based on their algorithms' signals. Trading strategy. Market makers hold inventories of securities and manage their risk by balancing buy and sell orders. They adjust their prices to maintain a neutral position and avoid large directional exposure to market movements. HFT firms use a variety of strategies, including arbitrage, taking advantage of price differences between exchanges, statistical trading, and liquidity provision. Their algorithms analyze market data in real time and execute trades based on complex patterns and market conditions. Risk exposure. Market makers face inventory risk, as they may hold positions that can lose value if prices move unfavorably. They also have regulatory obligations to provide liquidity, which can be risky during market downturns. HFT firms minimize holding periods to milliseconds or seconds, significantly reducing exposure to price movements. Their main risks include technological failures, market crashes, and regulatory changes. Market impact. Market makers provide stability and liquidity, reducing transaction costs for investors by ensuring that there are always buyers and sellers available. HFT firms can enhance liquidity and improve price discovery but may also contribute to market volatility, especially during flash crashes when their algorithms simultaneously withdraw from the market. Revenue model. Market makers earn revenue mainly from the spread between bid and ask prices. The spread compensates them for the risks of holding inventory and providing liquidity. HFT firms generate profits through rapid trade execution, exploiting short-term price movements, and sometimes collecting rebates from exchanges for adding liquidity. Despite their differences, market makers and HFT firms share some common ground. Technology-driven, both use advanced technology, algorithms, and data analytics to make trading decisions and execute orders rapidly. Liquidity provision, both can contribute to market liquidity, although market makers are more consistent in their role, while HFT liquidity is more opportunistic. Profit from speed and efficiency are crucial for both, as faster execution allows them to stay ahead of other market participants. Market makers can face criticism during times of market stress when they widen spreads or pull back quotes, leading to decreased liquidity when it's most needed. HFT firms, often criticized for creating an uneven playing field where only those with access to the fastest technology can compete. Their strategies can also lead to increased volatility, particularly in cases of rapid, algorithm-driven sell-offs. How traders interact with the market. Traders' interaction varies depending on 1. Trading strategy. 2. Instrument traded. 3. Platform used for trading. How traders interact with the market. The way traders interact with the market is complex and multifaceted. From analyzing data and news to placing trades through advanced platforms, successful traders must combine knowledge, strategy, and discipline to navigate the often unpredictable waters of the financial markets. With the rise of technology, trading has become more accessible, but it remains a skill that requires continuous learning and adaptation. Whether through day trading or long-term investment, traders play a crucial role in the liquidity and functioning of global markets. 1. Understanding the market. 2. Type of traders. 3. Analyzing the market traders. 4. Market orders and trading strategies. 5. Psychology of trading. 6. Interacting with the market through technology. 7. Impact of news and events. How can investors make money in the stock market? There are two primary ways investors make money on the stock market. These are as follows. 1. Capital gain. If the stock's price increases, you can sell it at a higher price than you paid, earning a profit. 2. Dividends. Some companies pay out part of their profits to shareholders in the form of dividends. Types of stocks. There are two main types of stocks. Common stocks. These provide ownership in a company and typically come with voting rights. Shareholders may receive dividends, but these are not guaranteed. Preferred stocks. These generally do not offer voting rights, but provide a fixed dividend, making them more like a hybrid of stocks and bonds. Risk and reward hash. The stock market can be rewarding but also comes with risks. Stock prices fluctuate based on a variety of factors, including company performance, economic conditions, and investor sentiment. While stocks offer the potential for higher returns than more conservative investments like bonds or savings accounts, they can also be volatile, with prices rising and falling over short periods. Getting started. To begin investing in the stock market, individuals typically open a brokerage account. From there, they can buy and sell stocks, either on their own or with the help of financial advisors. Many investors also invest in mutual funds or exchange-traded funds, ETFs, which pool money from multiple investors to buy a diversified portfolio of stocks, reducing individual risk. In summary, the stock market is a powerful tool for building wealth, but it requires knowledge, strategy, and an understanding of the associated risks. With careful planning and a long-term perspective, investors can harness its potential to grow their assets and achieve financial goals. Market makers play a crucial role in ensuring market efficiency and price stability. Their presence helps reduce volatility and improves the overall trading experience for retail and institutional investors. How to participate in the stock market. Participating in the stock market is an accessible way to grow your wealth over time. Here's a step-by-step guide on how to get started. 1. Educate yourself. Understand the basics. Before investing, it's important to learn how the stock market works, the different types of stocks, and the risks involved. Read books, follow financial news, and use online resources to build your foundational knowledge. Familiarize yourself with key concepts, learn about market indices, stock exchanges, dividends, and other fundamental terms. Understanding how factors like company earnings, economic data, and interest rates affect stock prices will help you make informed decisions. 2. Set clear financial goals. Determine your investment objective, identify why you want to invest, whether it's for retirement, buying a home, or another financial goal. Your objective will help you decide how much risk you're willing to take and how long you're willing to invest. Risk tolerance. Assess how much risk you're comfortable with. Stocks can be volatile in the short term, but long-term investments typically yield higher returns. Your risk tolerance depends on factors like your age, income, and financial situation. 3. Open a brokerage account. Choose a broker. You'll need a brokerage account to buy and sell stocks. Brokers can be traditional firms like Fidelity or Charles Schwab, or online platforms like Robinhood or E*Trade. Compare fees, account features, and trading tools to find the best fit for your needs. 4. Decide what to invest in. Individual stocks. If you're interested in specific companies, you can buy individual stocks. It's essential to research the companies thoroughly, look at their financial health, industry trends, and market position. Exchange-traded funds, ETFs, and mutual funds. These funds offer a diversified portfolio of stocks, reducing your risk by spreading your investment across many companies. ETFs are traded like stocks, while mutual funds are typically purchased through fund companies. Index funds. These funds aim to replicate the performance of a market index, like the S&P 500. They offer broad market exposure and are a popular choice for long-term, passive investors. Fund your account. After opening your account, deposit funds via bank transfer. Most brokers have a minimum amount required to start trading. 5. Monitor your investments. Stay informed. Keep track of market trends, economic news, and the performance of your investments. Regularly review your portfolio to ensure it aligns with your financial goals. Avoid emotional decisions. Market fluctuations can be unsettling, but reacting emotionally, e.g., panic selling, can result in losses. Stick to your long-term strategy unless there's a substantial change in your financial situation or goals. 6. Reinvest dividends and regular contributions. Reinvest dividends. If your stocks or funds pay dividends, reinvesting them can accelerate your wealth growth through the power of compounding. Contribute regularly. Regular investments, e.g., monthly, can help you build wealth steadily over time and smooth out the impact of market volatility, a strategy called dollar-cost averaging. Type of investors. The stock market offers opportunities for various types of investors and traders, depending on their goals, risk tolerance, and time commitment. Whether you prefer long-term investing, short-term trading, or something in between, understanding the different approaches can help you choose the strategy that aligns with your financial objectives. Here's an overview of the various types. 1. Retail investors. Description: individual, non-professional investors who buy and sell securities, stocks, bonds, ETFs, etc., for personal accounts. Typical characteristics are as follows. Smaller portfolios. Varying levels of knowledge and experience. Use of online brokerage platforms like Robinhood, TD Ameritrade, etc. 2. Institutional investors. Description: large organizations that pool money to invest on behalf of clients or members. Examples include pension funds, e.g., CalPERS. Mutual funds, e.g., Vanguard, Fidelity. Hedge funds. Insurance companies. Endowments and foundations. Typical characteristics. Large portfolios. Access to sophisticated tools and research. Often have a significant impact on market movements due to the size of their trades. 3. Accredited investors. Description: high net worth individuals or entities that meet certain income or net worth criteria set by the SEC. These investors can invest in private equity, venture capital, and other alternative investments that are not available to the general public. Typical characteristics. High income, over $200,000 per year, or net worth, over $1 million, excluding primary residence. Access to riskier and less liquid investments. For angel investors. Description: wealthy individuals who provide capital to startups or early-stage companies in exchange for equity or convertible debt. Typical characteristics. High risk tolerance. Hands-on involvement with startups. Early-stage investment opportunities. 5. Venture capitalists, VCs. Description: professional investors who manage venture capital funds. These funds invest in high-growth startups with significant potential for returns. Typical characteristics. High-risk, high-reward investments. Often focus on tech startups or industries with disruptive potential. Active role in company strategy and development. 6. Private equity investors. Description: investors who pool money to acquire stakes in private companies or take public companies private, often with the goal of restructuring and selling them at a profit. Typical characteristics. Long-term investment horizon. Focus on improving operations, financials, or management. Involvement in leverage buyouts, LBOs, and other large transactions. 7. Hedge fund investors. Description: high net worth. Individuals and institutions that invest in hedge funds. Hedge funds use a variety of strategies, including long-short equity, derivatives, and leverage, to generate returns. Typical characteristics. Use of complex strategies, including derivatives, short selling, and leverage. Focus on absolute returns, often regardless of market conditions. Typically higher fees, e.g., 2% management fee, 20% performance fee. 8. Sovereign wealth funds, SWFs. Description: state-owned investment funds that manage large pools of money generated by the country's revenues, often from natural resources like oil or gas. Examples: Norway's government pension fund. Abu Dhabi Investment Authority. Typical characteristics. Large, long-term investments. Often target infrastructure, global equities, real estate, and alternative assets. 9. Corporate investors. Description: corporations that invest in other companies, often through corporate venture capital, CVC, arms or strategic partnerships. Typical characteristics. Strategic investments to align with business goals. Focus on synergies, acquisitions, or market expansion. 10. Value investors. Description: investors who look for undervalued companies with strong fundamentals but lower stock prices. Famous examples: Warren Buffett, Benjamin Graham. Typical characteristics: long-term perspective, emphasis on financial analysis and company fundamentals. Buy and hold strategy. 11. Growth investors. Description: investors who focus on companies that are expected to grow at an above-average rate, often in terms of revenue and earnings. Typical characteristics: focus on companies with high growth potential, even if they have high valuations. Often target tech or innovative sectors. Tolerance for higher volatility. 12. Income investors. Description: investors who seek regular income from their investments, typically through dividends, interest, or rental income. Typical characteristics: focus on dividend-paying stocks, bonds, REITs, etc. Conservative or moderate risk tolerance. Stable, predictable cash flow. 13. Speculators. Description: investors who take on higher risk with the expectation of substantial returns, often in the short term. Typical characteristics: high risk tolerance. Frequent trading, e.g., day trading, options trading. Focus on volatile assets like cryptocurrencies, penny stocks, or commodities. These different types of investors shape the market dynamics through their varied strategies, risk profiles, and time horizons. Summary: the stock market offers an accessible way for individuals to invest and build wealth over time. Understanding how it works, the risks involved, and the strategies to manage those risks is crucial for making informed investment decisions. By investing wisely, individuals can participate in the growth of companies and the economy while working towards their financial goals. Thanks. If you have enjoyed the general overview of the market, please like and subscribe for future videos.